In this example, we are going to be looking at the journal entries to record when a merchandising business purchases inventory for their company. So there's a few important reminders that we want to take a look at before we get into our example. First, we have to look at credit terms. So if credit terms are offered, for example, something like 210 net 30, the inventory and either cash or accounts payable, depending on how the company is paying for this purchase, is recorded at the total value of the merchandise purchased minus the discount that's being offered. So when we're looking at those credit terms, 210 net 30, what that stands for is that the company is being offered a 2% discount if they pay the invoice within a 10-day period. If not, the net, that's what the N stands for, meaning the total amount that is outstanding, is due within 30 days. If the shipping terms are FOB shipping point, the buyer must pay the shipping charges, and the shipping charges are recorded as an increase to the inventory account. FOB stands for free on board, meaning that it's only free to the buyer until it hits its shipping point. And in order for it to be shipped, the buyer has to pay those shipping charges. We want to include that in the inventory account value because we want our inventory account to truly capture how much it's costing us as the business to acquire our inventory, so then we know how to price it for our customers. If credit terms are offered and the business does not pay the invoice during the discount period, the discount amount is recorded as an increase to the inventory account. It's costing us more money to actually acquire our inventory than technically it should have. In theory, companies should be able to take advantage of any discount that is being offered to them. If the company returns some of the merchandise, the debit is to either accounts payable or cash, depending on how the merchandise was originally purchased, and the credit is to the inventory account for the value of the inventory less any discount from the credit terms that were offered. So now that we've reviewed these important reminders, let's get into our example. So in this example, they tell us that Warwick Company is a women's clothing store. They purchased $75,000 of merchandise from a supplier on account. The terms are FOB destination, 210 net 30. Warwick's returned $9,000 of merchandise, receiving a credit memo, and they want us to journalize the entries to record the purchase, the merchandise return, and then first the payment if they were able to pay within the discount period of 10 days, and then for D, if they were unable to pay within that discount period. So just taking a look at this, what the company is purchasing is inventory for their business, and the total value is $75,000. The shipping terms are FOB destination, meaning it's free on board to the buyer until it reaches its final destination, which means that the seller is responsible for paying the shipping charges. We are also being offered a 2% discount if we pay that invoice within 10 days. If not, that net value or the total outstanding balance is due within 30 days. So let's journalize our entries. So since we don't have a date here, we're just going to indicate it with a letter. So for A, what we are purchasing is inventory. Again, anytime credit terms are being offered, we have to record our inventory and either our cash or accounts payable at that net value, which means the total value of the inventory minus any discount that's being offered. So the total value of the inventory that we're purchasing is $75,000, but they're offering us a 2% discount, which means that we're going to record it at 98% of that value. 100% would be at the $75,000. Minus the 2% gets us to that $98,000 value. So our inventory is going to be recorded at $73,500. We have credit terms. So anytime we see any version of our credit terms, we know that it was not a cash transaction. So we have to credit our accounts payable for the same $73,500. This is showing us what we should technically be paying for this inventory. Again, in theory, companies should be able to pay within their discount period if they're managing their cash properly in their business. In part B, they asked us to journalize the entry for the return of our inventory. We're sending back the gross value of $9,000 of inventory. So what we're going to debit is how we originally paid for that inventory. So we didn't pay cash, so that company's not going to give me cash back, but they're going to reduce how much that we owe to them sometime in the future. So we're going to debit our accounts payable. The inventory that we were returning was technically worth $9,000. However, back in transaction A, we recorded it at its net value, so less that discount. So again, we're going to multiply it by 98%. So we're going to reduce our accounts payable by $8,820. And what we are in fact giving back is some of our assets. So we are going to credit our inventory for that same $8,820. In Part C, they wanted us to journalize the entry for the payment, assuming that we made the payment within that 10-day discount period. So when that happens, we have to reduce our accounts payable account because we are in fact paying it. We originally owed $73,500. We returned $8,820 in terms of a net value. So how much we owe during this period is $64,680. And we know in order to pay off an accounts payable, we have to spend cash. So our asset is going to decrease by the $64,680. In Part D, it said to assume that we are paying the invoice, but we're paying it after the discount period had expired. So we still have to debit our accounts payable because we're reducing our obligation. It's still going to be for the $64,680. We can't, in fact, remove it for more or less than what's already in the account. So we're still going to remove it for the $64,680. However, we owe more than that $64,680 because we're not getting that 2% discount. So we have to go back and actually increase our inventory account because in fact our inventory is costing us more money to acquire by not paying within that discount period. So when we're looking for how much we're going to increase our inventory account by, we have to look at the gross values. So originally we purchased inventory that in total cost $75,000 in gross value. We returned $9,000 worth of inventory in terms of gross value. So that would leave us technically with a value of $66,000 that we owe. $64,680 of that is being accounted for in our accounts payable account. So that means we're going to increase our inventory account by $1,320. Again, we want our inventory account to truly capture how much it's costing us to acquire our inventory so that we know how much to then charge our customers. And then finally, we have to credit our cash for the full amount that we owe to this supplier. We owe them a full $66,000 because we did not pay them within that discount period.